Hey there, this is Cody Garrett, and during this video, I'm going to walk through the 2025 federal income tax formula step by step, referencing this Form 1040 spreadsheet along the way. Please note that this spreadsheet should not be used for tax preparation or specific tax advice. It's just a general example of the federal income tax formula for educational purposes only, and you might even find some mistakes I've made along the way. So the sheets you see at the bottom within this spreadsheet represent the income tax forms and schedules with results that flow to this Form 1040, which are the two first pages of the federal income tax return. Before we get excited and start inputting the various income sources, we first need to select the filing status. In this case, we can choose from single, married filing jointly, or head of household. And we also need to identify how many of the taxpayers are age 65 and older. These two combined selections affect the standard deduction, the additional standard deduction, the new senior deduction, the marginal tax brackets for both ordinary and long-term capital gains income, the combined income limits for Social Security taxation, net investment income tax, and the additional Medicare tax. So for our first example, let's start by assuming a retired married couple filing jointly age 65 and older, so we can see how it all flows from here. So we start with income on lines 1 through 15 on the Form 1040. In this example, the couple is fully retired and they don't have any W-2 employee wages. They receive a Form 1099 INT for their interest, so let's say they have tax-exempt interest from municipal bonds of $1,000. Then we have taxable interest reported from bank accounts, CDs, and individual taxable bonds, including the U.S. Treasury securities, of $5,000. And this does not include interest earned within tax-deferred retirement accounts, since those are generally excluded from gross income. Next, we're going to split the ordinary dividends from Form 1099 DIV into qualified and non-qualified dividends. The qualified dividend income receives the preferential long-term capital gains tax treatment of 0%, 15%, or 20%, as we'll see shortly. So let's assume this couple receives qualified dividends of $12,000 and non-qualified dividends of $6,000. Those non-qualified dividends commonly include the income from bond mutual funds and ETFs. So the qualified dividends of $12,000 plus the non-qualified dividends of $6,000, that equals ordinary dividends of $18,000. So next are lines 4 and 5, which include the taxable distributions from retirement plans, pensions, and annuities, reported on Form 1099-R. You'll notice that on this spreadsheet, I've separated line 4B into normal retirement account distributions and Roth conversions to make the year-end tax planning easier to visualize. Let's assume this couple is in their mid-70s, they're receiving RMDs, those required minimum distributions, and they're distributing $35,000 from their traditional IRAs. They haven't converted any of those pre-tax funds to Roth IRAs this year, but they're considering it. And they haven't received any qualified plan distributions or annuity payments for line 5. Although line 6 is next for Social Security, we actually need to skip it for a moment since the taxable portion of Social Security benefits must consider lines 7, 8, and 10. So line 7 includes the net realized capital gains or losses they might have received Form 1099-B from their taxable brokerage accounts. The net long-term capital gain receives the favorable tax treatment similar to those qualified dividends before. But in this example, let's assume this couple benefited from tax loss harvesting and have a net capital loss of negative $3,000 to offset other income. Any net losses beyond the negative $3,000, let's say negative $10,000 left over, those will carry forward to offset future capital gains, rinse and repeat. Moving to lines 8 and 10, we must reference our sheet for Schedule 1 Part 1, which is additional income, and Schedule 1 Part 2, which are adjustments to income. On Schedule 1 Part 1, the additional income of lines 1 through 10 commonly includes sources such as net self-employment income from Schedule C and net rental real estate or pass-through entity income from Schedule E. For this first example, let's assume this retired couple doesn't have any additional income from these sources. And moving over to Schedule 1 Part 2, the adjustments to income of lines 11 through 26 are often called above-the-line deductions, and those commonly include health savings account HSA contributions that are not made through payroll withholding. Also, the deductible half of self-employment tax, self-employed retirement plan contributions, the self-employed health insurance deduction, and deductible traditional IRA contributions. The couple in this example does not have access to those, but I'll share another scenario after this. Back to the Form 1040, now we can return to that line 6B to determine the taxable portion of Social Security benefits. And to calculate that, we need to go to the Social Security worksheet, which is an IRS publication 915. On this sheet, we simply enter the gross Social Security income amount from Form SSA 1099. Let's say they receive $3,500 per month combined, so $42,000 for the year. To determine the amount included in gross income, the first step is calculating what's called combined or provisional income, which is half of Social Security plus other income, including the tax-exempt interest. In this case, we add the tax-exempt and taxable interest of $3,000, total dividends of $18,000, and the IRA distributions of $35,000, which equals $56,000. We then add half of the Social Security income, which would be $21,000, so $56,000 plus $21,000 equals combined income of $77,000 for this purpose. In the next part of this calculation, the combined income is compared to base amounts based on filing status. With combined income below $32,000 for a married couple filing jointly, none of the Social Security income would be included in gross income. Between $32,000 and $44,000 is up to 50% included in income, and above $44,000 is up to 85% included in income. This sheet is auto-calculated, and in this case, $34,050 of the $42,000 of Social Security benefits, which is about 81%, is included in gross income. And we might see this percentage change later as we consider Roth conversions. Going back to the Form 1040, the taxable portion of Social Security flows to line 6B, and I've added a cell right next to it to remind us of that portion as a percentage, which cannot exceed 85%. Now that we've completed lines 1 through 10, our adjusted gross income, also called AGI, is $89,050. This is often called the line, and before we had above the line deductions. Now we're going to move to the below the line deductions. First is the standard deduction, which is $31,500 for a married couple filing jointly in 2025. And you can also reference those numbers to the right for each filing status. Next is the additional standard deduction, which is $1,600 per spouse age 65 or older when filing jointly. You'll notice when filing single or head of household, the additional standard deduction in 2025 is $2,000 instead of $1,600. In this example, since we selected married filing jointly and both age 65 and up, both spouses will receive the additional standard deduction, so $3,200 total. Although most taxpayers take the significant standard deduction, some may be able to itemize their deductions on Schedule A to receive a larger benefit. Those itemized deductions commonly include medical and dental expenses that exceed 7.5% of the AGI floor, state and local taxes, also called SALT, capped at $40,000 this year with income thresholds, home mortgage interest, and gifts to charity with AGI thresholds depending on the type of gift and what type of charitable organization. Going back to Form 1040, next is the qualified business income, the QBI deduction from Form 8995, which provides an additional reduction, generally 20% of qualified business income for eligible pass-through business owners and real estate investment trust REIT investors. In this basic case, our taxpayers do not have any QBI, but we'll see that with our next example. Lastly, we have the new senior deduction, formerly called the Enhanced Deductions for Seniors from Schedule 1A. This spreadsheet automatically calculates the deduction, including any reduction based on modified adjusted gross income. In this case, with the filing status, this couple's income is less than $150,000, so each spouse receives their full $6,000 senior deduction. It's pretty incredible. This couple received combined below-the-line deductions of $46,700, which has wiped out over 60% of their ordinary taxable income. After all those deductions, their taxable income is now $42,350, which is split into ordinary taxable income of $30,350 and long-term capital gains taxable income of $12,000. Now that we've covered the income section, we're ready to move to the tax and credits section to apply the respective ordinary and long-term capital gains tax rates, starting with the ordinary taxable income of $30,350. The first $23,850 of ordinary income is taxed at 10%, which equals $2,385 in tax, and the remaining $6,500 is taxed at 12%, which equals $780. So that combined ordinary income tax is $3,165. So what about this long-term capital gains taxable income of $12,000? With combined taxable income of only $42,350, all of those qualified dividends are taxed within the 0% long-term capital gains tax bracket. So ordinary tentative tax of $3,165 plus long-term capital gains tentative tax of $0 is total tentative tax of $31.65. Now to go from tentative tax to total tax, we need to add any additions to tax from Schedule 2 Part 1 and other taxes from Part 2. We'll add these numbers to our self-employed example. Non-refundable credits are also subtracted here. It's pretty incredible that for this married couple with income of $98,000 from a lived experience perspective, they only pay $31.65 in total federal income taxes. And if we scroll up to the top, this is an average effective tax rate of only 3.2%. The final sections of the Form 1040 include any tax withheld or paid throughout the year, plus any refundable tax credits. In this example, let's assume the couple withheld 10% from their RMDs. So out of the $35,000 in gross distributions, they withheld $3,500 that'll show up on their Form 1099-R. Those total payments are subtracted from total tax to determine the amount overpaid and refunded or owed. Although it doesn't show up in this example and it's not auto-calculated here, a tax penalty may also apply. Before we jump to the next example with self-employment, I want to show you the marginal tax rate chart above. This chart here shows us how much more room is available within each marginal federal tax bracket for ordinary income. For example, the top of the 12% marginal tax bracket is ordinary taxable income of $96,950, and our current ordinary taxable income is $30,350, with a difference of $66,600. Now with year-end tax planning, here's where the circular math gets fun. First, before Roth conversions, only 81% of the Social Security income was included in gross income. If we add a Roth conversion of $64,345 to this scenario, which converts to the top of the 12% marginal tax bracket, three things happen. First, that additional income from the Roth conversion makes the maximum 85% of Social Security become includable in gross income. Second, our ordinary taxable income increases to $96,950, resulting in an ordinary income tax increase of $7,992. And third, since long-term capital gains taxable income is stacked on top of the ordinary taxable income, that qualified dividend income of $12,000 is now all taxed at the 15% long-term capital gains tax bracket instead of the 0%, which added tax of $1,800. So to summarize, the Roth conversion of $64,345 pushed total tax from $31.65 up to $12,957, which overall has an effective tax rate of 8%, but the effective tax rate on the conversion amount is actually 15.2%, when we initially assumed it would be taxed at 12% within the ordinary bracket alone. This scenario is not meant to scare or confuse you, but instead to help us understand how planning tactics can impact other areas without our awareness. As promised, let's run through another example, but this time with a single self-employed taxpayer under age 65. Let's call her Grace. So I've started over with the template. We select single as the filing status and 0 for taxpayers 65 and up. In this example, Grace has $1,000 in taxable interest income from her savings account, $6,000 of qualified dividends from her taxable brokerage account, net long-term capital gain of $3,000, and net short-term capital gain of $2,000. And since she's self-employed as a sole proprietor, let's jump over to Schedule C. We enter her gross sales of $120,000 and business expenses of $20,000, resulting in a net profit of $100,000. With net profit from self-employment, she'll also have to pay self-employment tax, so let's go to Schedule SE. Her net profit of $100,000 is first multiplied by 92.35%, which is 100% minus 7.65%, which is the employer's portion of that self-employment tax. Keep in mind that Grace is acting as both the employer and the employee. That results in net earnings from self-employment of $92,350. Since that amount is fully within the current Social Security wage base of $176,100 in 2025, that full amount of $92,350 will be subject to Social Security tax of 6.2% for both the employer and employee, which equals 12.4%. So 12.4% times $92,350 equals Social Security tax of $11,451. And next is Medicare tax, which is 1.45% for both the employer and the employee, which together equals 2.9%. So 2.9% times $92,350 equals $26,778. In this case, Grace's net earnings are low enough that she is not subject to additional Medicare tax of 0.9%, based on her filing status. So her total self-employment tax is $14,129, and half of that will be deducted as an adjustment to income on Schedule 1, Part 2. As an owner of a pass-through business, Grace is also eligible for the Qualified Business Income QBI deduction. So let's go to that sheet next. One important piece of education regarding the QBI deduction is that it is not 20% of net profit from the business. The term qualified business income starts with the net profit, but that's reduced by the deductible half of self-employment tax, the self-employed health insurance deduction, and the contributions to qualified retirement plans. At the bottom of the sheet, we see an example of how much Grace could contribute to a traditional solo 401k. Her maximum employee contribution is $23,500, which is the lower of the 2025 limit and her net earnings from self-employment. She could also make an employer contribution of $18,587, which is the lower of the remaining all additions limit, or 20% of net earnings from self-employment. The available combined employee plus employer contribution could be $42,087. Grace is personally able to contribute $10,000 to her solo 401k, so we'll enter that here. Moving over to Schedule 1, Part 2, Grace also enters $6,000 for the self-employed health insurance deduction and $4,300 for maxing out her HSA contribution since she's covered by a high-deductible health plan HDHP. So now we can go back to that Form 8995 and see that her qualified business income, her QBI, has now dropped to $76,935. We multiply that QBI component by 20% to get $15,387. In this case, she does not have any REIT or publicly traded partnership income, so her QBI deduction before limitation is that $15,387. Next, which is also auto-calculated, her taxable income before the QBI deduction is $68,885. We also subtract her combined net long-term capital gain and qualified dividends of $9,000, which arrives at $59,885, and that number is finally multiplied by 20% to get the income limitation of $11,977. So the QBI deduction is the lesser of $15,387 or $11,977. Please note that this educational example and the spreadsheet do not account for the phase-outs for high-income taxpayers, especially in the Specified Service Trade of Business, SSTB. So we're going to take that QBI deduction and flow it to Form 1040. Grace's adjusted gross income is $84,635, which is reduced by her standard deduction of $15,750 as a single taxpayer, and the QBI deduction of $11,977, which results in taxable income of $56,908. The first $11,925 of her ordinary taxable income is taxed at 10%, and the remaining $35,983 is taxed at 12%, for ordinary tentative tax of $55,10. Although the tentative tax is $67.94, we must also add other taxes from Schedule 2, Part 2, which in this case is $14,129, specifically for her self-employment tax. And here's that look at Schedule 2, Part 2, with her self-employment tax on line 4. This is a really important concept of self-employment. So we notice that of her total tax of $20,923, 68% of that was just from the self-employment tax, not the income tax. Many self-employed business owners are caught off guard only considering the income tax, not the self-employment tax. Let's say that Grace is aware of self-employment tax and has been intentionally saving her tax liability along the way. To meet the safe harbor rules for tax payments, in her case, it's likely the lesser of 100% of last year's tax liability or 90% of this year's, which would be about $19,000. She could have made those throughout the year as quarterly estimated tax payments since she doesn't have any W-2 or 1099-R withholding opportunities. At the end of the year or the beginning of the next year, through looking at exercises like this, Grace identifies that she owes a little bit more in taxes, which she plans to pay by the April 15th tax filing deadline. So there's a lot of information here. I hope this hasn't overwhelmed you. I hope you've enjoyed this overview of the federal income tax formula. Measure twice and keep finance personal.